Welcome, everyone. Thanks for joining us here today for another installment of the Options Industry Council's webinar series. My name is Edward Modla, a principal of investor education at OCC. OCC is the clearing corporation that provides OIC as an educational resource to market participants. Happy to be here with you today to discuss part one of a two-part series on the Greeks today, featuring Theta, Vega, and Rho. Before I get started, two things I want to mention to you. First of all, please take the survey that's attached to this presentation. We review all of the comments and the feedback that we get from everyone that takes the time to do that. Also, utilize the Q&A box on your console. I will have some time at the end to answer those questions, but also got two colleagues of mine, also OIC instructors that many of you know. Mark Benzequin and Ken Keating are online behind the scenes looking for your questions, ready to answer them. So please feel free to utilize that Q&A box, send your questions through. First, our disclaimer: options are not suitable for everyone. They are a rather complex tool that needs to be well understood before you use them in a live account. And if you're looking for more from OIC, here's where you can find us, optionseducation.org. We were founded back in 1992 as an educational resource to help market participants understand not just the benefits, but also the risks. We take that very seriously. We want investors to use the product wisely. That's how they're going to find long-term success. So we do focus on both benefits and risks. Plenty of podcasts, online courses, videos, webinars, and utilize our service desk. You can send options-related questions by email to options@theocc.com, and our team will respond questions about what we have, what we offer, or any options-related questions as you're going through your educational journey. Here's the outline for today. I'll have a few words to say about Greeks overall, and then we'll get into the three Greeks that are in focus for today: Theta, Vega, and Rho, definitions, examples, and some comparisons of where they might be the greatest or where they might have the least effect. And then, as I said, we'll set aside some time for questions at the very end. The five Greeks, the first order Greeks, are commonly known as Delta, Gamma, Theta, Vega, Rho. These are the ones you most often will see if you're looking at your trading platform and you have the Greeks by number displayed. These are the ones you're probably going to see up there. We're focused today on the Theta, Vega, Rho. We'll get to Delta and Gamma in part two in December that I hope all of you can join us for. Now, I said this is first order. There's also second order and third order Greeks that get more complex and start to compare different variables to each other. But we're going to focus in this two-part series on the first order Greeks and take it from there. I want to set the table today by talking first about pricing models and generically how they're formed, what they mean, and then how the Greeks fit into those models and what they represent. When you think about the entries into a pricing model, you have some inputs on one side, which include stock price, strike price, days to expiration, volatility, interest rate, dividends. All of that goes in on one side of the equation. And on the other side, you calculate an options value. The Greeks are an attempt to isolate one of those inputs and change it while keeping all of the other inputs exactly the same, and then see what kind of effect does that change have on the options price. It allows an investor to isolate where their risks are and what one change in the stock price or data expiration or volatility levels or even potentially interest rates and dividends might have on the options price. And now you can also back solve for the Greek. Instead of inputting all six of those variables and calculating an options price, you can instead observe what the option price is in the open market and back solve for a Greek. That's most commonly done for volatility. And when we get to that segment on implied volatility in Vega, I'll dig a bit deeper into that concept. So you have the 5 Greeks. We know what they are. They're measuring changes in one variable to estimate what kind of effect that's going to have on an option's price. Let's start today with theta, which is more commonly or commonly referred to as time decay. Theta is the option value's sensitivity to time, specifically with the passage of 1 day. How much will the option value change? It's expressed in decimal form and indicates to the investor, all else equal, if 1 day passes, we would expect the option value to change by this amount. It's a negative amount because calls and puts generally have negative theta amounts, meaning if you buy options, you're suffering from theta, and if you sell options, you're trying to capture theta. It's also displayed per calendar day and not trading day. You might think that because it's per calendar day, you can sell options on Friday morning or Friday afternoon and capture a quick 3 days worth of time decay over the weekend. And that is true, and some investors do try to do that and say that they can do that with some level of success. However, a couple things to say about that. First of all, you are taking 3 days worth of risk over the weekend for something to happen on a micro or macroeconomic scale, a political or military scale. You have a full weekend where something can happen in this world that moves the markets. And we have seen some instances of that happening and the market having adverse moves on a Monday morning. So selling on a Friday has 3 days worth of risk. Also, reflecting back to my days on the trading floor in the late 90s, options market makers know that a weekend is upcoming, and when the market was relatively quiet and there was nothing expected to occur over the weekend, it was very common for me to adjust the days to expiration. So I was making markets off of option values that were more reflective of Monday morning than they would be of Friday afternoon. Market makers aren't interested in buying options all day on Friday either. So you have those couple of things to consider when it comes to that concept of calendar day and weekends, particularly holidays. Let's look at a quick example of theta. It's relatively simple arithmetic. We have an option trading for $3.50. We're noticing on our screen a theta of 3 cents. This just simply means that all else equal, the expected value that we might see tomorrow would be $3.47, 3 cents less in the option premium amount. Now, if this is all the information we had and we were trying to forecast out further in time, say 10 days from now, we have 3 cents per day times 10. That's 30 cents or $3.20. Now, I can tell you that the 10-day forecast will not be accurate. That number is not going to be correct because theta is not a constant number. It's not going to be 3 cents from one day to the next. It's going to change. There's an evolution of theta and an acceleration of decay that is not going to be consistent with one day to the next. This is commonly showcased as a curve, which we're going to spend some time looking at right here. For in-the-money options and also out-of-the-money options as well, you have more of a linear or straight line rate of decay. It's not exactly going to be a straight line. There'll be some level of curvature there, but in the money and out of the money options have relatively small amounts of time decay in the premium itself. So with the passage of one day to the next and over time, it's a very slow, gradual, and mostly linear rate of decay. At-the-money options are very different. At-the-money options are your strike prices that are pretty close, relatively close to where the stock price is currently trading. And what you observe there is a very slow rate of decay with a lot of time left till expiration, say a year or 9 months out. And once you get to that roughly 40 days until expiration, right around 6 weeks or so, the time decay begins to accelerate. And it continues to accelerate all the way through expiration. The fastest level of time decay you will observe will be expiration week and expiration day. Specifically, when an option opens up on expiration day with some value, if it's time value and the stock doesn't move, by the closing bell, that value is 0. That's 100% rate of decay. Buyers and sellers of options are constantly trying to figure out where on this curve do they want to be, but they also have to consider the premium of the option itself and their market outlook. This curve doesn't mean that buyers should never buy an option with 6 weeks left because it's right at that spot on the curve where acceleration of decay increases. They should be aware of that spot. But it's perfectly possible that an investor has a market outlook where 6 weeks looks like the right time frame, and maybe there's an earnings announcement hanging out there that they want to capture. Option buyers will understand where they're at on the curve and realize they need stock movement in their favor by a magnitude that's greater to overcome the effect of time decay. As you get closer to expiration, again, from the buyer's perspective, they're willing to accept very fast rates of decay in exchange for relatively small premium amounts. If the stock moves to a relatively great extent in a short period of time, even though you're suffering accelerated decay, the option holder can experience some nice gains if the stock moves in their favor. Sellers, of course, are very aware of this. Sellers are trying to capture decay. That's why you're selling options in the first place. It's not too common to see investors go far out in time, 9 months or 12 months, and sell options to try and capture decay. Most sellers are looking at that 6, 7, 8 week level and then deciding, is that the spot where they'd like to sell options? It could be sooner than that. Other investors like to sell 1 week, 2 week, 3 week options because of that fast decay. But all the while, you're measuring where are you at on this curve? What is the rate of decay that you're capturing? And comparing that to the option premium. The premium that you are selling needs to be worthwhile. And the last thing I'll say about this is that time decay is occurring constantly. A common question that I'll get is, when does time value come out of the option? We see this number, 3 cents, 5 cents, 8 cents. When does that happen? At the closing bell, at the opening bell? And it's really constantly happening as time is ticking away. And back to that example of, say, expiration day. If an option has value at the opening bell and it doesn't have any value at the closing bell, it has decayed throughout the day, hour by hour, minute by minute. And that's how time decay works. It's constantly coming out of the option. But it's such a small increment when you have the hourly analysis that it's more than reasonable to look at those numbers on a daily or calendar day basis. So let's do a little knowledge check on time decay and theta, ask a few questions to see how you've absorbed the material. Have shares trading at $100, and we're looking at this particular put spread, the 95.90 put spread. The investor purchased this spread for 50 cents, the 50-cent debit, and the question is, does theta help or hurt this position? And this is relatively straightforward. The investor here purchased the 95 put, sold the 90 put. Those are both out of the money options. They paid a debit of 50 cents. That is all time value, and they paid for it. So with the passage of time, as time value decreases, this investor is hurt with the passage of time and the effect of theta. Next question, comparing two options to each other. First of all, the long 80 strike calls for 20 1/4, or the long 85 strike puts for 40 cents. Which of these two options is more affected by time decay? As one day passes, which one of these options is going to lose more value? I'll give you a second to think about that. with shares trading at 100, the 80 strike call is $20 in the money, meaning $20 of intrinsic value. That portion of its premium will not decay. Intrinsic value does not decay. It's sensitive to stock price movements. The remaining value, or the 25 cents, is time value. That's what's going to decay in the 80 strike call. The 85 strike put is out of the money. Its premium is 40 cents. All of that is time value. With the passage of 1 day, it is the 85 put that has more time value, subject to decay, and it will be more affected with the passage of time. Our last question, a more general thought-provoking question: is it possible to buy an option and have positive theta? In other words, you purchase an option, you own it, and with the passage of time, the value increases. Is that possible? And as we think this through, I don't want this to sound like a trick question. I'll answer it in one way and then explain it afterwards. So first of all, if you were to buy an option and for it to increase in value with the passage of 1 day, you would have to have purchased that option below its intrinsic value for it to start gravitating upwards. Now, in practice, that's not likely to happen, particularly with equity options. You're not likely to find a circumstance where you can execute that. However, it is a normal circumstance when you take the example of deep in the money European put options. I won't spend too much time on here because it can get a little involved, but I think it's an interesting educational lesson that I'll just describe briefly. Think about what it means to buy an expensive, deep in the money put option. You're paying a lot of capital for that. You're tying up a lot of cash. If the option is American style, at some point, it's not worth it for you to have all of that cash sitting in the option when you can instead exercise it and receive the strike price in cash. Holding cash is valuable. So at some level, if the option was American, you'd want to exercise it and instead of holding all that cash tied up in the put. Well, European options don't offer that possibility of early exercise. You can only exercise a European put option at its expiration day. Therefore, an investor commonly, if you're tracking prices of European puts, you might see investors, they're not willing to pay intrinsic value because they're tying up their capital. Conversely, the seller might be willing to sell below intrinsic value because they're paid up front and they cannot be assigned until expiration day. In more common language of that, if someone were to offer you $999 today and ask you to pay them back $1,000 in a year, that might be something you're willing to do because you can make more money than that, than the dollar you have to give up. As long as you could not be asked to pay $1,000 early, and that's the case of the European option, it can't be assigned early, and you will often notice that dynamic where deep in the money European put options trade below intrinsic value, and with the passage of time, the value of the option actually increases and gives the option holder a positive theta. I wouldn't expect too many investors to ever come across that, but if you do track options chains on index options and European options, that might be something you observe, and now you know why that happens. It's certainly an interesting note to take if you're trading index options. Now let's look at implied volatility and Vega. This is the great unknown is implied volatility when it comes to options pricing. Market participants are always trying to figure out where the correct level is, and it's always a struggle to figure out where that should be. Now, I'm going to start with historical volatility, and we can compare the two. Historical volatility looks backwards from today into the past of what a stock price has already done. It's observed, it's factual, and it's a statistic. Looking back at what the stock has done and then calculating what is the annualized volatility level that has been observed in this stock over a certain time frame. And the investor can determine for themselves if they're interested in a 10-day historical volatility level or a 30-day or a 90-day. It's up to you. What time frame are you interested in? And again, it's looking back. Implied volatility, I'm going to define that in a few slides and pick it apart more, but it's looking forward from today, moving forward with historical volatility helping to shape what the market believes implied might be or should be. First, let's look a little bit more at historical in the form of a hypothetical example. Got three different stocks here. Stock A with a 15% historical volatility. Then you have stock B higher at 25, stock C higher at 35. Stock A with the lowest level of historic volatility has seen the most observations near the mean level, that $100 mean level. See the most observations there, and it also has the most narrow top to bottom range of prices. Stock C, which is the highest level of historical volatility, has the lowest amount of observations, around 100, and the widest top to bottom range. Now, if you were only given this information and you were asked to price options contracts that expired in 2 weeks, and this is all you had, you very well might price options on stock C higher than stock A. And that would make perfect sense based on what you've observed in the past. But of course, we know more than just historic volatility. There's other information out there. Most notably, earnings. That's going to come up a few times as I go through volatility discussion. What if stock C had earnings a few weeks ago, and the stock is now starting to settle down at a comfortable level, and stock A has earnings coming up in a week, and the market is settling down and getting comfortable before that earnings announcement, at which point you might see some volatility? Well, given that information, you certainly might be pricing options that expire in 2 weeks for stock A at a higher level of potential volatility than stock C. Those market circumstances all need to be considered. Now, if you're going to do that, one analysis that's commonly done is to look back, say at stock A, it's got earnings coming up. Where should implied vol be? Well, you can look at past earnings events and witness what type of stock movements did we see after previous earnings announcements, and then gauge where might be a reasonable level to price options to capture this earnings event. Of course, all events are going to be different, but it gives you some idea. And the key takeaway that I was trying to get from this slide is that historical volatility is a measuring stick. It's a data point. It helps. But by no means can you say that the implied vol looking forward is going to necessarily reflect historical volatility levels that we've seen in the past, especially on a short-term basis. Let's now look to implied volatility. This is really what we want to talk about. Implied volatility only exists in the options market. It is specifically defined as the volatility level that justifies an options price. Now back to the pricing models. If we're going to calculate an implied volatility level, we are going to leave it as an unknown. And we'll insert stock price, strike price, days to expiration, leave volatility unknown, insert risk-free interest rate, dividends, and then observe the option price. Insert the option price, and then back solve for implied volatility. With that description, hopefully it makes more sense that it is the volatility level that justifies a particular options price. As you change the options price, keeping everything else the same, implied volatility is going to change and then justify that new price. Now, all market participants are moving volatility levels because all market participants are moving options prices. Those are bids and offers from everybody. You, me, professionals, market makers, banks, institutions, everybody that is putting in bids and offers into the marketplace is moving options prices. Therefore, they are moving implied volatility levels. I said you can calculate implied volatility given an options price. That is done at each strike price. There is a unique implied volatility level at each strike price. The market calculates what those levels are, and then if you connect the dots to draw a skew, you have now the implied volatility curve, or sometimes called the implied volatility skew of a particular stock. Generally speaking, implied volatility levels are higher for lower strikes, but not necessarily true, particularly this year in some very high-profile symbols and names. We've seen those skews invert as the market rallied tremendously throughout the summer. Market participants were trying to capitalize and capture that upside and were less concerned about the downside, and skews inverted, which is an odd market circumstance most of the time, and particularly with index options, the skew is such that lower strike options have higher implied volatility levels, and then that skew tends to lower and bottom out just above the at-the-money options. Now, it's rather intuitive and might be simple to understand that given all other factors remaining constant, an increase in implied volatility means that the potential future prices of calls and puts will widen. It'll get wider on both ends, on both sides, meaning both call and put prices increase. As implied volatility decreases, the potential or expected range of stock prices top to bottom will shrink, get smaller, and both call and put prices therefore decrease. Also, changes in implied volatility are greater for long-term options than they are for short-term options. And that's rather easy to understand. Think about an option that expires in a day versus one that expires in a year. If you increase implied volatility by 1%, that's really not going to have much of an effect on where those future stock prices are if you're only looking out one day. But if you're looking out for an entire year, 12 months, that range is going to be affected, and call and put prices will therefore be affected to a much greater extent. The longer dated options at a given strike, given a certain level of implied vol change, the longer dated option is going to be affected to a greater extent. Certainly, investors might want to forecast and try to predict if there are changes in volatility, and there will be. How much is that going to affect the options price? And that is measured by Vega, the volatility Greek, the option value's sensitivity to changes in implied volatility. With a 1% point change in implied volatility, how much value in decimal form, in monetary form, might we expect to see this option value change by? Both calls and puts have positive Vega amounts, as we said before. As implied volatility goes up, both calls and puts are going to increase in value by the expected, by that Vega amount, and as implied vol goes down, you might expect the options on both sides to decrease by the Vega amount. Now, implied volatility, we're saying here, this is with a 1% point change. Oftentimes, implied vol is changing by far more than just 1%. And this is some investigating you might want to do to check out and get a better sense of how much of an effect do these changes really have on options prices. Now, I would recommend go to an options calculator. We've got one on our website in our quotes and calculators section, and input all of the variables, assume a certain volatility rate, calculate an options price, and then start to move the implied volatility. Keep everything else the same, move implied volatility. Start it wherever you want it. 25%, and then move it to 20 to 15 to 35 to 30, and see what that does to the option price. And that can give you some respect for the importance that implied volatility changes have on the option premium amount. Those big changes in volatility are most often observed around earnings. Let's go through a hypothetical example of an earnings situation. Stock is at $100, a few weeks to go to expiration. Implied vol is at 50%, and you see this 105 call trading for $1.85. And then you get the announcement. The stock moves higher by 5% up to 105 a week later. But then you also have this implied volatility down to 30%. And even with the stock moving $5 or 5% higher, the call value is considerably lower than it was prior to earnings. Now, this example is not meant to shy anybody away from buying options before earnings. It's just to be aware of what kind of move do you need in order to be profitable. If you were looking at a calculator, and this was before earnings, and you moved implied vol down to 30%, days to expiration down to 6, you could start to look at different stock prices to see, where do I need this stock to be in order to be profitable? And that gives you a better idea. You still might want to buy this option because you think that kind of a move is going to occur. Now, this example is hypothetical. It's not taken from a real-world example, but it's realistic. And if I was posed with this situation, I would assume that for this particular stock, at previous earnings events, the move in the shares was greater than 5%. There just wasn't enough there. If there was an 8% or 10% move, then yes, this option buyer could have made a decent amount of money. Option buyers are looking for that move to be to a greater extent than they lose in days and implied vol, and option sellers are doing the opposite. They know vol is probably going to work in their favor. If they sell options before earnings, they know some days are going to come out, but the stock could move to such a great extent that they still lose, and option sellers are evaluating that. Now, also, an interesting dynamic around earnings happens prior to the announcement. You may often hear that implied volatility ticks higher or moves a little bit higher prior to earnings. And that may lead an investor to think that they could purchase options a few weeks before earnings and then sell those options a few days before earnings and capture that rise in implied vol. And that's certainly possible. But let's go back. Again, I'm going to reflect back on the pricing models. And this will be the most complex example I gave with the pricing models. Prior to earnings, you still have days that are passing. And you might not have buyers disappearing. Because the earnings announcement's out there, buyers may be holding those bids relatively strong. And sellers might not be aggressively lowering their offers, again, because they know earnings is upcoming. So now with the pricing model, if everything's staying the same, stock price isn't moving, we know the strike price, we do have changing days to expiration from, say, 13 to 12 to 11. We're going to solve for implied volatility. Interest rates and dividends are the same. And we have the option price that is not changing because buyers are holding their bids. Sellers are not lowering their offers. If days are decreasing and the option value is the same, implied volatility has to go higher in order to justify that option's price with fewer days left until expiration. This is the kind of thing you do see before earnings announcements, implied volatility drifting higher, but not necessarily because prices of options are going up. They certainly might be, but not necessarily the case. It could be that they're just not changing or even drifting a little bit lower, but not by as much as they would otherwise in normal circumstances. Just be a little careful with that, and it's also an explanation that gives you a better understanding of how the pricing model and this definition of justifying an options price works its way into the equation with stock price movements, days to expiration, implied volatility, and the option price itself all either working in the same direction or working in different directions and having an influence on each other. Let's do a knowledge check here with volatility and Vega. First of all, with a 100 strike call, is Vega greater on a contract expiring in 5, 30, or 90 days? Hopefully you all got this one because I spoke to this very directly just a few minutes ago. Vega and implied volatility's effect is greater for longer dated options. So the 90-day option here will be greater affected. Next question, an investor puts on an iron condor trade. Remember, an iron condor is selling two vertical spreads, selling a call spread using out of the money option, selling a put spread, and doing both of those at the same time. Does this investor have a long or short Vega position? Have they bought or sold volatility? And will an increase in Vega help or hurt their trade? Two-part question. And I'll give you a second to think about that. So as a general rule, when you are selling options, you have an inverse relationship. Your profit and loss has an inverse relationship to the movement in volatility. So if you sell options and volatility goes up, that's going to hurt. That inverse relationship means you're short. You're short Vega or you're short volatility, meaning you want the volatility to go lower. If volatility increases, then you would also be hurt. So a short position that would also be hurt by increases in implied volatility. And the last question here, if a stock drops 15% as a result of some unexpected company news, are long or short Vega positions likely to be positively impacted? It's really somewhat a two-part question that works on the assumption that when you have a market circumstance with the stock dropping a significant amount, unexpected news has come out, now you've got a traumatic market situation, those are generally correspond to increases in volatility levels. If you see that increase in volatility, you would like to be long options, which means long Vega positions. You would hopefully have that position on because the long side will be positively impacted. Now, this isn't necessarily a rule, doesn't have to occur this way, but again, there's an assumption here that when a certain market circumstance occurs, like a drop to this extent, you have rises in implied volatility. Conversely, when you have very slow, gradual moves higher in share prices, that is understood to be the most comfortable and calm market condition where volatility usually is at its lowest levels or continues to drift lower. That is somewhat where the volatility skew comes from, the fact that those downward moves tend to be sharp and traumatic, and the upward moves tend to be a bit calmer. Now let's look at the last Greek for today, which is going to be Rho. And I'm not going to have a knowledge check quiz here on Rho, but I at least want to define and walk through what Rho is and how calls and puts are affected by changes in interest rates. Rho is the option value's sensitivity to interest, or the expected change in option value with a 1-point change in the risk-free rate. Now that is specifically the risk-free rate between today and expiration day. And it's expressed like the others in decimal monetary form, cash amount per option. It's considered the least significant of all pricing factors, perhaps because of that 1% number. Remember when I was talking about Vega and I showed 1% change in volatility, and I explained oftentimes volatility changes by a whole lot more than 1%. And that's why Vega and volatility is so important. Well, with Rho, it's the opposite. It's expressed as a 1% point change, but it's very uncommon. You're not going to see interest rates change by 1%. They're going to be slower at a fraction of that level, gradual over time, and predictable. In this day and age, we know where rates are likely headed before they head there. So a very predictable number, even when it does change, and those changes are far less than the 1% change that's going to be reflected by the Rho number. Nonetheless, the Rho and its input of interest rates, while unimportant or the least significant, are critical to pricing an options contract. And that's one of the 6 components that I've outlined a few times today that you have to put into an options pricing model, because trading options is largely about that cost of carry effect. When you buy a call, for example, you are not buying shares of stock. There's value in not paying for those shares and instead holding cash in your account. There's value, and you're willing to pay for that. And so this idea of cost of carry is where Rho gets its value, and it is required. It has to be part of that calculation for an options theoretical value. As we said, generated by pricing model, just like the others. And since Rho has that cost of carry element to it, that's based on a dollar amount, Rho is the largest for in-the-money calls and puts, which are the most expensive options, and also for longer-dated options, which, of course, are also going to be more expensive than their shorter-term counterparts. And if you have one key takeaway here, I'll read it and then translate it maybe into more simple terms that could be understood and remembered. As rates increase, there's going to be effect on both calls and puts, but not the same effect. As rates increase, calls increase in value, puts decrease in value, and as rates decrease, calls go down, puts go up. That's a key takeaway to remember. And here's another way to think about that. It's fair to say that options are priced off of a future value of today's stock price. It has nothing to do with market direction or market opinion on where the stock is headed. Just thinking about today's dollar amount stock price and then calculating a future value for that stock price. Now, I'll also say, let's assume no dividends. Dividends, of course, would affect that future stock price. So if you have a stock trading today at $100, it's not paying dividends, and the 1-year risk-free rate is 1%, then the future value of $100 is $101. And it is fair to say that options would then be priced, options expire in a year, would be priced off of that future value of 101. Now, if that rate increased, let's say it does go up by 1%, it increases up to 2%, then the future value of today's $100 would then be $102. That higher future value then means call prices go up, put prices go down. Maybe that's an easier way to remember the relationship between rates, calls, and puts. Increases in rates mean higher future values of today's dollar amounts or today's stock prices. Higher future values mean higher calls and lower put prices. There's one key takeaway there on Rho. That's what I recommend and suggest that you remember. So there's quite a bit on time decay, theta, implied volatility, Vega, some things on Rho that at least you now have an understanding. When you see it on your screen, you know what it's defined as and what it means, even if you're not using it in trading decisions. And if you do want to find out more before I get to questions, you can find us at optionseducation.org. Please look through all of the previous sessions that we've done. Look through our podcasts and our previous webinars and videos. And again, our service desk is there to help everyone out and answer your questions, not just in what OIC has to offer, but to answer your options-related questions as well. So please take advantage of that team. So let's see what we have as far as questions. Got a bunch of questions here. I can see Mark and Ken have answered quite a few of them. So, repeat a little bit here. So what's the difference between historic and implied? Historic is looking backwards. Implied is looking forwards. Historical is factual on what the stock has done. Implied is a volatility level that is used to price options contracts based off of some level of analysis on what might happen in the stock or in the market moving forward. So certainly, when it comes to which one is more influential, it's another question, which one is more influential? Implied volatility is what matters. Historic volatility is a reference, and you can use it to help determine what you might think or expect for future price movements, but implied volatility is what matters. Another question, how do you choose strike prices using this concept of volatility and implied volatility? Well, this is a very good question. If you're choosing between strike prices, one of the things you might want to observe is that volatility skew that I defined earlier. Particularly if you're buying or selling options, what level of implied volatility are you paying or selling compared to previous levels of implied volatility? And if you're doing a spread of some kind, which option are you buying and which one are you selling? And keep in mind that if you're buying a lower strike put option, for example, you might be purchasing the option that has the higher implied volatility level. That might be okay. You might need that put for the protection on your spread. But being aware of what the skew looks like in this year, when you had those inverted skews, for those of you familiar with the collar, if you own shares of stock in some very popular names this year, you could have executed a collar very easily at a credit. And we saw investors do that throughout the year because calls were trading for higher than puts. So you could purchase protection on the downside. You can sell a call to the upside, start to scale out of a position that's been working for you, and put that on at a credit rather easily. That's something to keep in mind and to watch for as volatility is going to change constantly and be different from one stock to the next. Another question about spreads. When you do a bull put spread, how do you calculate the Greek values? And this is an easier answer than you might have expected it to be. You calculate Greek values by simple arithmetic. You add them together. You subtract and add. That's all there is to it. This is the same thing we would do as professionals, as market makers, with hundreds and thousands of open positions across all strike prices, across all expirations. How do you know what your overall Greek exposure is with respect to Theta or Vega? It's simple arithmetic. You add them all up together and come to a net number, and now you know what your overall exposures are. And the Greeks all work together, and we're going to get into part 2 with delta and gamma. That all plays a role in how things change too. But you're going to add those numbers together, come to a net number, and then as one day passes, you're going to see what those changes are, and you're going to be able to observe what kind of exposures you have as time evolves. Sometimes there's another question about IVOL metrics, IVOL percentile, for example. Yes, if your platform offers this, there are a couple of metrics that you might want to look for. IVOL percentile, what it will do is it will compare today's level of implied volatility to how many times was implied volatility lower than today's level looking back over your time frame, which is usually a year. And it can give you a percentile. What percent of the time was implied volatility at a lower level than today? Another one, not mentioned in the question, is IVOL rank. It's another implied volatility analytical tool you might see, and this compares today's level of implied vol to the highest and lowest levels of implied vol, again, given your time frame, which is usually a year. So two different metrics that come at this from two different angles. Implied vol rank does not consider the number of observations, just the highest and the lowest number, that's it. Implied vol percentile will actually encompass the percentage of days that we've seen below today's level. The question here about an options chain, why is I-vol always higher the further away you are from the at-the-money strike? Yes, and I can see Ken's going to give you his perspective. I will as well. Implied volatility is generally its lowest just above at-the-money. And this is maybe your 48, 46 delta calls right there in that environment where the market is slowly and gradually moving higher. That's the most comfortable call market environment there is. So you would expect implied vol to be its lowest at those strikes. As you move lower, especially down in that put side, now options are a protective risk management tool. Investors, portfolio managers, money managers are using put options to protect portfolios. There's demand there. And we know moves to the downside can be sharp. So with that heightened demand for those put options, prices are higher. If the price is higher, implied volatility is higher. That's your traditional skew where you have higher implied volatility levels moving lower. So moving away from at the money down, you have higher implied vol levels. Well, you have the same kind of effect on the upside when you go further to the upside above those 48, 46 delta calls. You will have an uptick in volatility. Moves to the upside to a great extent or a greater extent than mild moves are also considered sharp. They're just nowhere near as concerning as the downward moves. So that's why that volatility skew I described is what this question is saying. As you move in either direction from, I'm not going to say at the money, but just above at the money to the upside, implied volatility ticks higher, and the slope at which it ticks higher is much, much greater on the downside for the puts. Let's see, what else do we have here? Where can I find the OIC calculator? That will be, pop open the menu if you're on our website, section 10. We have quotes and calculators. That's where you can find that. What is the impact of dividends on the Greeks? Well, dividends is going to be certainly a very important component of options pricing. As dividends go higher, you're going to witness the future value. Remember, talking about future value of stocks being what our options are going to be priced off of. You'll see that future value of stock change and lower. And as dividends are eliminated, we saw that again earlier this year. If you're observing dividends in 2020, more so than any year I can remember, with dividends getting slashed, those forecasted future dividends payments were removed, and future values of stock prices ticked higher. So really, dividends impacting the option price themselves. Looks like we've got everything answered. Ken and Mark really rattling off those answers really nicely. Lots of good questions and feedback and commentary. So I'll wrap it up here. I hope everyone found some good value from this. Again, please take the survey. Let us know what you thought of the presentation, the topic. We look at every single comment, good or bad. It helps us shape the program moving forward. So again, thanks everyone for joining, and we hope to see you for part 2 in early December, where I'll cover Delta and Gamma. Thanks again.